Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Colin Stewart, CEO and Portfolio Manager at JC Clark, is our guest co-host. Then, in 30 minutes, Joe O'Connors and Jared Lindzon, co-authors of Do More in 4, will be here to argue their case for the 4-day work week. And we want to hear from you this morning on First Call. You can reach out with your questions on North American equities, and we'll have Colin Stewart answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney is in Davos, Switzerland, to pitch Canada as an investment destination at the World Economic Forum. Carney is scheduled to meet French President Emmanuel Macron and is set to deliver a keynote talk about the emerging New World Order and Canada's plans to take a pragmatic approach to dealing with it. U.S. President Donald Trump is also at the forum, although it is not yet clear whether he will meet with Carney. Also at the World Economic Forum, Foreign Affairs Minister Anita Anand says Canada will bolster its presence in the Arctic. In an interview with Bloomberg, Anand said Canada will open a consulate in the semi-autonomous Danish territory of Greenland next month. This is a move that had been in the works before U.S. President Donald Trump triggered turmoil by threatening to take over Greenland. Netflix has reached an amended all-cash agreement to buy Warner Brothers as it battles Paramount to acquire the entertainment giant. Netflix had previously agreed to pay in cash and stock. Warner plans to call a special meeting of shareholders to approve the deal. Netflix says stockholders should be able to vote on the transaction by April. The changes are designed to expedite a sale and address claims by Paramount that its cash tender offer is superior. And now our top line story. All eyes are on Davos and the World Economic Forum as Donald Trump's push for Greenland continues to dominate the conversation. Joining us as this story continues to unfold and helping us make sense of it all is our guest co-host, Colin Stewart, CEO and Portfolio Manager at JC Clark. Colin, thanks very much for joining us today.
Good to be here, Roger.
Another quiet day in Trumpland.
Yeah,
not
something
much
to keep us on our toes.
Unfolding. We're seeing the markets react a little more to this one than any other things that Trump has done this year.
Yes.
I
mean, I think it's one of the surprising things to us has been that the equity markets have not reacted more thus far to the, array of wild things that seem to happen every week with Trump and his policy decisions. So, we've obviously seen some of the risk-off assets like precious metals, gold, silver rallying a lot. But, equities and even the bond market has been fairly calm thus far. And I think perhaps what we're now seeing is sort of the cumulative impact of all of these things adding up. I'm not sure if, Greenland was sort of the straw that broke the camel's back, but it was just, I think the cumulative impact of many, many different things and just the uncertainty. And at some point, it's been our view that equities would, react to this. And obviously, I think we also have, the bond markets off this morning with, I think, Japanese government bond yields up and people worried about sort of fiscal spending by different governments around the world. We have, I guess, the potential Supreme Court decision this morning as well. So a lot of things keep investors on their toes today.
Oh, yeah, I didn't mention that part yet. Yeah, we may hear from the court on on tariffs, that they may rule on it. They were talking maybe that we might get it next week or last week, but maybe today. They don't say when, so. What kind of an impact would that have if I saw on Bloomberg there was a 60% chance that they're going to say that the tariffs strike them down.
Yeah.
What kind of an impact would that have, do you think?
Yeah, I mean, I think the main impact would likely be if the Supreme Court were to strike down those IEEPA tariffs would be a negative reaction in the bond market. I mean, the idea that the U.S. is bringing in all this revenue from the tariffs, and if that is stopped and they have to, in fact, refund, $100 billion plus to other, companies and nations and what have you, I think that would be a concern for the bond market. I mean, as I think we all know, the U.S. fiscal situation is somewhat precarious already. There's, a lot of spending with Trump's one big beautiful bill, And the idea was that the tariffs were going to be a revenue offset to that spending. And so if we don't have those tariffs, I think the likely initial reaction, at least, would be for bonds to sell off, yields to move up, and there's some debate as to what that would do to equity markets. I think my view would be it would be at least an initial knee-jerk negative for equity markets, because obviously higher bond yields typically a higher discount rate for cash flows and lower P multiples, et cetera. So, I think it would generally be a risk-off situation, but, we'll have to see. And we don't even know, in fact, if that decision is going to come today from the Supreme Court. There was some speculation it could have been last week, but, with that, the Greenland, all this sort of back and forth between Trump and other leaders, it's obviously a lot to keep investors on their toes today.
And then throw in, I just saw a stat that said 50% of Canadians are actually concerned about the U.S. invading Canada. But the Canadian markets just keep. I mean, they were up yesterday, and they're I don't know. I can't remember that they're up for the year, but it's been a nice little run, and they outperformed last year. It's the gold and silver there, gold and the metals that are driving.
Yeah, there certainly that was a big contributor last year. But I mean, even if you step back, I think the Canadian non-material stocks did reasonably well last year. The U.S. equity markets, which are obviously not driven by precious metals, did well. I mean, some of that was technology, but global equity markets really everywhere had a good year in 2025, and investors have been sort of questioning, well, why is that if there's so many uncertainties? And I think part of it is the markets have become almost like we were talking about earlier, Roger, a little bit immune to what Trump does. He comes out with all this gusto, these very aggressive announcements, and then sort of he backs off. It's a bit back to this. I think they called it at one point the taco trade. Yeah. Trump always chickens out that he has this very aggressive stance, and then he kind of backs off that stance a little bit. So I think up until now, at least, and I know today see the futures down pretty materially. So the equity markets are clearly going to be weak today, and maybe they're, maybe there's sort of a breaking point here where markets are eventually, finally sort of at their breaking point, saying, well, we don't, maybe he is going to do some of these things, and that's not a good thing.
There is that possibility, right, where the sky actually is falling this time.
Yes, and I think as I said earlier, I think it's to us we're pretty defensively set up. Have been worried about this for a while, and I think eventually it's always hard as an investor to know what the trigger point for maybe not a bear market but a sell-off in the market might be. And there's you could if you look back in hindsight, you could say in 2025 there were 15 or 20 things that happened that could have caused that, and none of them really did. I mean, we obviously had that Liberation Day tariffs back earlier last year, which caused a sell-off and then a subsequent quick recovery. But you never know exactly what it's going to be, and it may not be that one event, but it's just sort of the cumulative impact of all them adding up, and eventually investors saying, okay, enough is enough. We're now actually really worried about these things, and so we want to have more of a risk off. And I think the other important thing for investors to remember is this is all against a backdrop of very historically high equity market valuations. So our view would be there's not a lot of room for error here, because PE multiples, at least, especially in the U.S. market, are at historic highs. And because of that, there's not a lot of margin for safety if there are problems or mistakes made.
All right, we're going to continue the conversation when we're coming up after the break. We're going to talk about Canada increasing its presence in the Arctic. This, according to Foreign Affairs Minister Anita Anand, and what kind of opportunities that might bring. We'll bring you her comments from Davos after the break, and we'll take a look at the markets before the bell. A lot of red there. Let's see how things are shaping up in the markets. Another interesting day in Trumpland. We'll start with the U.S. futures, and there you go. It says it all right there. It's all over the Trump threat of tariffs over Greenland. There's a bit of a tech and growth sell-off. That's all weighing on the markets right now. The futures, you can see the Dow's off by 1 1/4, NASDAQ off by nearly 1 3/4, and the S&P 500 off by 1.42%. In Asia, how did they finish the day here? The Nikkei, it's always a bit of a roller coaster, but it was down 1.1%. Hang Seng down by 0.29, and the CSI 300 off by 0.33. Heading over to Europe now, and you can see they are taking a hit as well. Broad-based losses, particularly being felt in the auto industrials and luxury consumer names. Those are the ones taking the hit right now, all over the concern about tariffs. FTSE off by 0.87, still over 10,000. CAC 40 off by 0.94, and the German DAX off by 1.3. And then there's the TSX, just moseying along, up again yesterday, 0.15% into record territory, driven by gold miners and materials in general. Investors looking for safe havens. Who were the movers yesterday? Let's have a look. I Am Gold up 9.73%. G Mining Venture up about 5.5%. Open Text down by about 4%, and Bitfarms off by about 5.6%. And the metals, no surprise here, they are surging again today, closing in on record territory. Gold up nearly 3%, silver up 7.36%, at 653, or up $6.56 at 95.10, not 6 Copper as well, it is up slightly, 0.33%, all of them sitting in or near record territories. Moving over to oil, and it was up 0.71% right now. It's at 45.60 for Western Canadian Select, and down south of the border, WTI, and it was up 0.89, but that was close, of course, for Martin Luther King Day yesterday, but pushing $60 a barrel again. Canadian Foreign Affairs Minister Anita Anand sat down with Lisa Abramowicz at Bloomberg House on the sidelines of the World Economic Forum's annual meeting in Davos, and she talked about Arctic security and U.S. relations. Have a listen.
I was the Minister of National Defence between 2021 and 2023 in Canada. And at that time, the Arctic, and indeed Arctic security and sovereignty, was very much on our radar, and it continues to be the case with the Russian illegal invasion of Ukraine, for example, and Russian infrastructure moving further and further north. We, as an Arctic country, 70% of our coastline is interfacing with the Arctic, 40% of our territory. We have no choice but to ensure that we are bolstering our Arctic presence. We are doubling, indeed, our troop work and deployment nationally and internationally. We're going to make sure that we increase our defense spending to 5% of GDP, as NATO allies are doing. This is our promise. $80 billion was in our last budget for defense spending.
Are troops from NATO going to Greenland and going to Arctic regions in order to protect against possible incursions from China and from Russia or from the United States?
So the question of troops in Greenland seems to be so prevalent. Let me just say, NATO allies routinely do exercises, military exercises together. That's a fact. The point that I've been raising with Mark Rutte, the Secretary General of NATO, is historically NATO's gaze has been eastward, on the eastern flank. Canada's largest military operation is Operation Reassurance in Latvia, for example. But what I've been saying to Mark Rutte, including before the attention has been focused on Greenland, is that NATO is the North Atlantic Treaty Organization. NATO needs to have a northern and western focus. This is clear. It is one of the primary reasons that NATO was founded, in my view. Canada's a founding member of NATO, and we deeply encourage a greater focus on the Arctic. And finally, I'll say I'm headed to Greenland, a trip that was planned long before the past couple of weeks' events took place. I'll be going with my Danish and, of course, Greenlandic counterparts to open formally the Canadian consulate there during the first week of February.
Are we watching the NATO alliance collapse?
Not at all. What we are watching is the focus on geographical areas that demand attention by the strongest military alliance in the world. Canada will continue to remain at the table. We are a multilateral believer. We believe in the strength of working cooperatively and collaboratively with our allies, including at NATO and other multilateral organizations. That won't change, but we're also pragmatic. And so we come to the table in order to lead, in order to ensure that the rules-based international order, although it is shifting, is extremely important for global stability.
Are you concerned that the sovereignty of Canada is being threatened by the potential threat on Greenland's sovereignty?
Canada will never be the 51st state. We will always ensure that we stand foursquare behind our NATO allies.
All right, that was Defense Minister Anita Anand. And she's talking about defense in the North, a lot of focus on the North because of the Northwest Passage and everything else might be opening up Greenland, minerals. Are there opportunities with everything that's unfolding right now, do you think?
Yeah, I think so. I mean, the defense and aerospace sector is something we've been focused on for the last year and a half. And I mean, obviously in the U.S., there are large, well-known prime contractors who, build planes and submarines and things like that. And the Canadian industry, at least among the public investable companies, has been fairly small. But that's an area in the market in Canada that's got a lot more attention over the last 12 months. And we've been lucky enough to own some of those stocks. Some companies that I would cite are names like Magellan Aerospace. They build, parts for engines. Some of that business is commercial and selling parts to companies like Boeing and Airbus, but they also have a large defense business and do things for, parts for the F-35 fighter jet, for example. There's another Ottawa-based company called Calian, which has a significant defense sort of training and helping to train the military, health services for the military, and obviously, it's got a lot of attention recently because of, the Canadian government's announcement of all the military personnel they plan to hire. And, I think there's a lot of focus, even in the last couple months, there have been a number of different banks and brokerage firms who put on these defense symposiums and had a lot of companies out to speak, to sort of educate investors. And there's, a part of that is certainly a push. And I was at one last week that RBC hosted, and part of that was really a talking about Arctic sovereignty and security and how we can bolster Canada's military presence in the Arctic. And it's not, it's obviously equipment, but there's personnel, companies that even build housing and infrastructure. I mean, it is an inhospitable place, I think, to be, and we don't have a lot of military presence there. And so I think this is for investors. Many of these stocks have run up quickly, but I think this to us is a sort of a multi-year, really decade-long theme as we see Canada and other NATO countries really now feel, I think, in this new world order, they have to invest more in defense in the Arctic. And
there's some disorder right now. I just want to bring it back to the markets because I was looking at some of the Magnificent Seven. They're all off. Amazon, Alphabet, Tesla, they're all, NVIDIA, all by 2%. Platform, Meta is off by 2.1%. On a day like this, when you see those markets, do you just kind of sit back and wait? What do you?
Yeah, I mean, I think
like
you can't react knee-jerk to any of these things. This is just one day. There have been, many days when these stocks have been down, and they've tended to, especially these large, big-cap tech stocks have been, as we all know, amazing performers over the last 5-10 years and last year as well. So, I think if the business has good fundamentals and you've done your homework and understand what you own and you believe the valuation is reasonable, there's no reason to panic on a day like this. But I think, really from more of an overall portfolio strategy, it's incumbent on investment managers like ourselves to sort of be prepared and set up our portfolio in ways that and as I said earlier, we're pretty defensively positioned, so we hold some cash in our funds. We're trying to focus more on defensive sectors that might do well in a tougher economic period, or if we do have a market sell-off. And I think as I said, it's really I think important for investors to be conscious of even though things have been very good. Some of that has been driven by strong earnings, but a lot of the appreciation in the market in the last few years has been driven by multiple expansion. So we see, particularly in the U.S. market, other than the 99-2000 period, valuation multiples are as high as they've really ever been in the last 30 years. So I think there's not a lot of room for error. So, our approach is more of a value investing approach. So we're trying to find things that maybe are a little more sheltered or defensive and trade at more reasonable valuation multiples.
Okay, we'll take a break on that note there, but we'll be back with Colin Stewart to see why real estate investment trusts are on his radar. That's next. Time to see what's on the radar for Colin Stewart, CEO and portfolio manager at J.C. Clark. And Colin, your eye on real estate. REITs have not been loved much lately.
No, and that's sort of exactly why we think
you
it's an
love
interesting opportunity. It's hard to find things in the market that are out of favor or beat up today, as we know many things have rallied and are at their highs and traded high valuation multiples. And real estate or REITs are one of the few sectors that have really underperformed. It did a little better last year, but if you look over the last 5 years, REITs have not performed well. I mean, some of that is for those logical reasons. Interest rates have moved up a lot from the COVID period where they were very low. That's obviously a headwind for REITs. We've had this work from home trend, so office real estate owners have really suffered. There's been concern for some of the industrial REITs about reshoring of U.S. manufacturing, and that might hurt some of the industrial property owners or REITs that own industrial property in Canada. But overall, we think a lot of those trends are reversing. We're obviously seeing people back to the office. There's some speculation that interest rates are going to come down more, which is a tailwind for REITs. And, I think overall, if you just look back over a really long period of time, 20, 30, 40 years, real estate's been a great investment. And generally, these investments are characterized by stable cash flow. They're stable businesses. Right now, the valuation multiples are low. Many REITs use that cash flow to pay out attractive dividends. So in an uncertain market as we have today, I think it's an out of favor area. Valuations are reasonable. There are some potential tailwinds that we think are emerging. And it's a stable sort of cash flow generating investment. So we think in a more uncertain time, it's a good place for investors to be.
And it seems like it's been a bit slow, because we've been talking about back to work for a couple of years, longer probably, but it's really felt like in the last couple of years you've seen more and more people who are actually back at work. Yet it seems like they've been slow to respond to that. But what's their occupancy like? How are they doing?
Yeah, I mean, it's slowly improving, and you're exactly right, Roger. I mean, the office real estate or the office REITs have been really the worst performing area, and it's been a real struggle for them. I mean, I think a lot of there are other subsectors within the real estate. For example, we've seen a couple apartment REITs; those have been good places to invest. InterRent and Minto, both taken private or taken out recently by large institutional investors, or Minto is still ongoing. So there are, the industrial real estate assets have done reasonably well. Retail owners of shopping malls have actually been doing well, but office, because it's been slow to come back and the occupancy rates, I mean, so there's a real bifurcation. The really AAA buildings have 95% plus occupancy, and the B and C buildings are still in the 80s. So it's, that environment's still a little tough, but, and we haven't necessarily been invested directly in office REITs, but, the one other thing happening in the Canadian real estate market is there's a real dislocation between the value for private, real estate assets and what's happening in the public market. And that's why we've seen some of this takeout activity recently with InterRent, a big apartment owner, and Minto more recently, just this year being taken private or taken out. The values or the valuations in the private market for these assets, if it's a long-term owner, a pension fund, for example, are willing to pay or value them at a much higher price, and the REITs in the public market are trading at a discount. So we're seeing some of this takeout activity, and we think that actually, could continue if that valuation gap persists.
Now, are those more opportunities then? They're going private, but does that open up some opportunities to see the value go up?
Yeah. I mean, I think the market has already reacted, but yes, exactly. For the ones that are left, I mean, we have a number of investments in real estate companies that we do think trade at a big discount to what their private market value would be. For example, if a pension fund were to come in and buy the whole business, or institutional investors, and for whatever reason in this period, because of some of the headwinds like rates, retail investors in the public markets have taken a sort of a broad negative view, and a lot of these real estate stocks have sold off, and that's one of the reasons we think they're attractive.
Okay, we're going to take a break on that. And still ahead, we're talking about a 4-day work week with our next guest, who's for it. And our phone lines will open up soon for our first call segment. You can reach us at 1-855-326-6266. Also, send us an email, first call at bellmedia.ca. Prime Minister Mark Carney is in Davos, Switzerland to pitch Canada as an investment destination at the World Economic Forum. Carney is scheduled to meet with French President Emmanuel Macron and is set to deliver a keynote talk about the emerging New World Order and Canada's plans to take a pragmatic approach to dealing with it. U.S. President Donald Trump is also at the forum, though it's not clear yet whether he will meet with Carney. Shares of 3M are falling in the pre-market. The maker of stationery products and electronics materials missed profit expectations for its full-year outlook. The American company has plans to reorient its new products and increase efficiencies across its industrial base. The CEO has been actively looking at shifting away from low-growth businesses and increase the company's use of digital products. And also, it wants to bring in products to the market faster. Silvercore Metals has acquired a 70% stake in Charat. It's a gold company for $162 million US. The gold mining company holds licensing rights to projects in Kyrgyzstan. The deal includes hosting fully permitted gold projects and surrounding exploration licenses. The Vancouver-based company commits to invest about $150 million US for phase one of the development of the mines in the Central Asian country. And looking in the markets, you might not want to look at them right now. Trump's comments about tariffs weighing heavily right now. It's the Dow's off by 1.3, the NASDAQ off by 1.8 almost, and the S&P 500 off by almost 1.5%. Today might be a good day to take a day off. So could a 4-day work week be the golden ticket to higher productivity in the workplace? Our next guests say that there is some strong data suggesting so. Here to talk about that are the co-authors of Do More in 4, Joe O'Connor and Jared Linson. Joe, Jared, thank you very much for joining us today.
Thanks for having us.
So a 4-day work week, we'll start, Joe, with you. A 4-day work week you think can work. Why?
Well, I think the 5-day, 9-to-5 work model that we've all become accustomed to, it was invented for an industrial era economy that no longer exists. This was back in a time when we had less than 20% of women in the workforce. It was back when work was really confined to a physical location and fixed hours of work. And we know that for most occupations, that is no longer the case. And so as we enter into this new age of AI, where the relationship between an hour of work and outcomes is going to be even more frayed, I think we need to reconsider whether this work model really works for the modern economy. And we also have a reality here in Canada where we are the economy that are the least excited about AI adoption. Only 9% of Canadians, according to Pew Global Research, say they're more excited than concerned about AI adoption. And so what we argue in the book is that the 4-day work week can be a very powerful incentive to get employees on board with new productivity initiatives and adopting new technologies.
Now, did we not kind of see a 4-day work week when it came to the pandemic and then working from home? Was that not a kind of test case that people could work on their own and work more efficiently? And we now see everybody coming back to work, Jared?
Well, I think there is some parallels there with hybrid work. We talk a lot about how before the pandemic, a lot of companies could work remotely and be effective. Employees could be effective working remotely, but they just weren't bold enough to try it. And then the pandemic forced us to try it. And that kind of gave us permission to say, well, what else might be beneficial to organizations, to employees that we're overlooking just because of the inertia, because we've done things a certain way for so long. So I think more than anything, the pandemic just gave us permission to question whether these longstanding norms are really suited for today's reality. And as Joe mentioned, the reality is that the 5-day work week was created for an industrial economy that no longer exists. Hours are growing because we are no longer sort of limited in our work to a physical location. We're working around the clock. We still measure people's output in hours, which is a really outdated way to measure productivity in a knowledge economy. And so there's a lot of reasons and a lot of data that we share in the book that shows that you can actually reduce hours by really focusing on everyone's attention on the things that really matter, on driving business outcomes, rather than letting those hours pass in work that doesn't really matter.
So, Joe, are you suggesting in the book that people on a 4-day work week will actually be more productive than they would have under the old model by working more hours, or just using productivity tools like AI, or what's the productivity bridge from the 5-day to the 4-day? How does that?
So we argue that in the current model, the incentive structure is broken. And what I mean by that is often for high performers, if you find new and efficient ways to do your job, new innovations to become more efficient, often the only reward that you get is for more work and more tasks to be loaded onto your plate. Meanwhile, if you take longer to complete your tasks, you work through your lunch break, you work into evenings, you work into weekends, often you're lauded as being more promotable, more committed, more dedicated to the job. And so the 4-day work week is a strategic tool to actually realign the incentive structure, to have employees pushing in the same direction as the organization, trying to achieve the same goals. And if you think about the impact that AI is going to have on work, the efficiency parts of productivity, so task speed, task volume, process speed, process volume, increasingly these types of tasks are going to be outsourced to AI. What's that going to mean? It's going to mean that the things that are important for human performance are being effective, creative ideas, making good decisions, making good judgments, critical thinking. Those things are not maximized by maximizing the number of hours people spend on the clock. They're about managing people's energy, their focus, their well-being, and their motivation. And the 4-day work week can be a really effective strategic tool to maximize all of those factors.
Now, how do you do it with industries that are 5 days? Stock market, for example, it's almost 24 hours a day. How do you balance it with that and industries that work on weekends and things like that?
Yeah, so we actually have an entire chapter of the book called "But What About My Clients?" And it looks at different unique solutions that organizations have taken in order to answer that very question. And we see a whole lot of different creative ways of doing it. We profile one company that actually does the 4-day work week by doing half-day Fridays, half-day Mondays, because they realize nothing important really happens before noon on Monday or afternoon on Friday. We've profiled other organizations that assign individuals to be on call one at a time. So, every quarter, you're that one person who is waiting by the phone, and if anything happens, you have to be available and ready to answer a customer need. We have found a lot of creative solutions to fill that gap, and often what we find is that the challenge, it looms larger in the mind than it proves to be in reality. We already are accustomed to doing a little bit of work here and there on a Saturday or a Sunday if we need to on the evenings. A lot of the times when the question is, how are you going to handle things that come up on that 5th day? The answer is, how do you handle things today when it comes up on a Saturday or a Sunday?
And does this carry over to manufacturing and industries like that where you have to be there and you have to build things? You can't rely on AI or as much on AI?
There's no question this is more complex in those types of industries where there is a more direct connection between a unit hour of labor and productive output. But I've worked with many manufacturers over the years, and one of the things that we found is that connection isn't quite the same as it was when most people were working on assembly lines. As a result of technology, actually, machine operators, a lot of their productivity isn't just about running the machine, but it's about collaborative problem solving. It's about, are they running multiple machines during that productive hour of labor? So actually incentivizing people to do better work, to do more efficient work, translates across multiple contexts. Actually, in many modern manufacturing environments, because paid overtime is relied on by so many people as part of their core salary, again, you have people almost leaving work to be picked up at the weekend. So we've seen how this can actually prove very effective across a multiplicity of different contexts.
And Jared, in a white-collar environment, do you take a view in the book on whether those 4 days should be in office, work from home, or does that sort of relate at all to the productivity and what you're talking about in a 4-day work week?
Not as directly as you might think. The two issues are somewhat related, but not super direct. So we see a lot of organizations that are struggling to get their employees back into the office can use the 4-day work week as a strategic tool to encourage that sort of enthusiastic return to office rather than, really taking a hit to morale. A lot of the things that people like to do at home, little errands throughout the day, maybe sleep in because you don't have to commute, spend less time and money on, lunches. All of those things you kind of get back in a 4-day work week. So it is a solution for organizations that are struggling to switch back into the office. However, we also find that organizations that are already really well set up to operate on a remote basis tend to already be a step ahead in terms of making the transition to a 4-day work week. A lot of the stuff about productivity and efficiency and finding that extra time in the workday, it's easier when your organization's already operating in a very digital way where things are measured and recorded, and it just sets it up a little bit better.
Okay, we're out of time, but I got one last quick question for do you work a 4-day work week?
I do.
And you like it? And do you find it works?
I definitely find it works. And I just want to make one final point. You've been talking about Trump, tariffs, the situation south of the border. Most of the analysis would suggest the reason we've ended up in that position is because people felt left behind by the last great advances in globalization and digitalization. So as we enter this age of AI, we need to be thinking about how can we share the benefits of these time savings, of these productivity gains with the workforce. And I think a 4-day work week is absolutely the right place to start.
Okay. Jared, you work a 4-day week?
I work 32 hours, but across 5 days.
Okay.
Yeah.
Perfect. Well, thank you both for joining us today. You want to show the book quickly?
Yeah, absolutely.
There
Here
we
it
go.
is.
Do More in 4. The co-authors are here with us right now, Joe O'Connor and Jared Linson. Thank you very much for joining us.
Thanks for having us.
Maybe it'll come in. Fingers crossed. All right, still ahead, today's market drivers with Bloomberg's Monique Malima. And of course, our phone lines are open. Colin Stewart CEO and portfolio manager at JC Clark, is taking your questions on North American equities. Call us at 1-855-326-6266. You can also email us, first call at bellmedia.ca. Well, let's take a look at some of the early market movers, and we're joined now by Bloomberg equity reporter Monique Malima. Monique, thanks as always for joining us. And first up, Sienna.
Yes, so Sienna, their shares are down in pre-market trading today after Bank of America downgraded the stock. They said that they see more opportunities for growth of the backlog, but they think that it's about to reach the peak in terms of the company's backlog. And they see from there that the valuation then would be a little rich. They also note that a number of hyperscalers and network providers are pulling back on their capital expenditures this year, and that's going to weigh on companies like Sienna that work with these firms. So they just say that a lot of the focus is now going to shift on how do they continue to grow their revenue going forward.
Okay, and next up, I just want to get in one more stock, and then we're going to talk about Greenland and everything else that's unfolding there. But Southern, what's going on with that?
Yes, so Southern, they are a utilities company in the U.S., and their stock was downgraded this morning at Wells Fargo. They say that the company has actually quite a robust pipeline and has strength from management, but the company is facing a lot of political uncertainty. They have seen some changes in Georgia, which is one of their biggest markets, in terms of the utilities board there that's been weighing on shares over the past year. And there's another election coming up this November that they think could have even more of an impact on the company. A number of legislators have raised concerns about affordability in terms of utilities and wanting to crack down more on that. So they say until this election comes in November and investors have a clearer picture on where things are going to go, there's still going to be that pressure on shares.
And then, of course, big picture right now, everything that's unfolding with Donald Trump and Greenland, that is kind of wreaking havoc everywhere, isn't it?
Yes, definitely. So in the U.S., we see the S&P 500 and the NASDAQ 100 futures are down in pre-market trading. And this is really because Trump announced over the weekend that he was going to put in place a 10% tariff on 8 European countries for their support with Greenland and for putting troops into Greenland as the U.S. is looking to seize Greenland. And this is really weighing across many different sectors. We see gold and silver up as investors are seeking safe havens, so that's lifting the miners. We're seeing pressure on risk assets as people are trying to manage their geopolitical risks. So we're seeing crypto stocks down, technology stocks down. And then we're also seeing some of the international companies, like in consumer goods or automotive, that are seeing their share pressure because of these tariffs. If these are put in place, these companies that operate globally are going to see the impacts of that. And it's important to note that the U.S. markets were closed yesterday for Martin Luther King Jr. Day. So this is the first trading day that they're seeing since Trump has announced these tariffs. So this is mirroring some of the moves we saw yesterday in Europe and in Canada, now in the U.S.
Okay, and then just to throw in one more thing, just for the fun of it, Japan, the bond market.
That one I'm not too sure on, so I won't speak to that. But we're seeing global.
Sorry, I didn't mean to put you on the
today.
spot. We had it in there, so it's all part of it. It's kind of playing havoc with a lot of things. We'll leave it on that note there, Monique. Thanks, as always, for joining us. Bloomberg's Monique Malima. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets from J.P. Morgan. Let's take a look at some of the notable analyst calls and recommendations from J.P. Morgan for today. And energy stocks are mixed in pre-market trading as J.P. Morgan analyst Arun Jayaram sees a cautious outlook for the oil market with lower break-evens despite geopolitical risks from Russia, Ukraine, Venezuela, and Iran. J.P. Morgan cut the recommendation on Cenovus Energy to neutral from overweight with a price target of $25. They see Cenovus's cash return trailing peers due to higher leverage. And the analysts also raised the recommendation on Suncor Energy to overweight from neutral. The price target is $75 US as they see the valuation as attractive compared to Canadian peers. And JP Morgan cut the recommendation on ConocoPhillips to neutral from overweight, noting that Conoco has lower break-evens than peers due to lower sustaining capital requirements, but investments weigh on the firm. That price target is set at 98 US. When we come back, Colin Stewart, CEO and portfolio manager at JC Clark, takes your questions on First Call. All right, time for First Call, first email, and that comes from Tony. He would like Colin's take and outlook for gold in 2026, and where is it going?
Yeah,
well, that's a good question.
That is a good question. I wish I knew. I mean, we don't have a ton of exposure to gold, but it's not surprising to see it continue to be very strong here with all the geopolitical risks out there, all the the tariff concerns and the uncertainty in the world. So it really has been a risk-off asset. There's been some weakness, as we all know, in the U.S. dollar as well, and that tends to benefit gold and silver. So, I think as long as that uncertainty continues, the market volatility, the U.S. dollar weakness, the outlook for gold is probably pretty good, albeit I think it's important to realize it has had a big run. A lot of gold equities have had a big run, so it's becoming a bigger portion of the Canadian index, the gold stocks, and maybe not a bad time to sort of resize your weighting in gold if you've had a ton of exposure to it.
Are there any mining companies or gold companies that kind of can avoid the ups and downs of gold, or they're all have any managed to do that?
Some of them, in the past, more gold companies hedged their exposure to the commodity, but it went out of vogue a number of years ago. So fewer of them do. I mean, some of the gold royalty companies perhaps might be a little more stable way, cash flow driven approach. To get participation in that, where you're just collecting the cash flow from a royalty stream on the mine and don't actually own the underlying asset, perhaps a little bit less operational risk there. So that sometimes is seen as a safer way to play that sector. But I mean, ultimately, the direction of the commodity is really paramount.
Yeah. All right. Let's get back into REITs. And this one's from Len. It says, is Allied Properties REIT a good place to add a position?
Yeah, we're still a little cautious on the overall office market, and Allied is one of the larger office REITs in Canada. They tend to own some of those properties that are maybe not the tall office buildings downtown as much, but some of the the King West loft type spaces that might be a little more exposed to technology companies and things like that. And at least in Toronto, not on the path. And they cut their distribution last year. Their occupancy has been improving a little bit, but perhaps not as much as some of the other players in the office market. So, we do think, and we are seeing, certainly in Toronto and other centers in Canada, this return to office trend. So I think that will, generally help all of the office REITs. But, I think Allied still has perhaps some company-specific issues. So it's not one that we own right now.
Okay, so in Toronto we have a place called The Path, which connects all these buildings downtown. Is it that much of a factor for a building to be on the path?
I think it is, and particularly when we see the weather like we have now, and it's minus 12 degrees outside. People like to be on the path, access to transit, can go to the gym, and don't have to run outside. And we've definitely seen in the Toronto core, I think those buildings that are on the path, and obviously the nicer buildings with newer, better amenities, those ones have come back more quickly and have much higher occupancy than some of the ones that might be on Yonge Street that aren't directly on the path, or older buildings, or ones that are in King West. So there's been a bit of bifurcation there, where the lower quality buildings and the ones that aren't directly on the path have not seen their occupancy come back as much.
All right, let's get to another email. And this one's from Elizabeth. Could you please ask your guest to evaluate the Exchange Income Core stock?
Yeah, Exchange Income is an interesting business. It's somewhat diversified, and they have a number of different businesses, but it has an element of the business that is really exposed to the sort of the defense sector and is benefiting from this, what we talked about earlier, concerns about Arctic security and development of the Arctic. They have an airline business where they do a lot of transportation and really have a monopoly type position on that transportation in the northern region in Canada. And there's been a lot of focus on that. We obviously heard Anita Anand talking about that earlier, and this idea that Canada is going to really have to bolster, military presence in the Arctic, and that's going to lead to all kinds of other logistical issues of, building places for people to live, military bases, transportation of goods, transportation of people, and exchange income is very well positioned for that. And because, we talked about it earlier, Roger, there are so few ways in the public markets in Canada to get exposure to the defense and aerospace sector, even though it doesn't represent 100% of exchange income's business. It is an increasingly important component, and the company is well run, pays a dividend, trades at a reasonable valuation. So the stock's done very well, and we don't own it, but we certainly have followed it and think it's a good business and a good one to be invested in.
Okay, we're going to get one more email in here. This one's from Elmo. What is your opinion on Constellation Software today? Is it a good buy or is it risky, and has it bottomed? I think good buy as in a good buy as a deal, or not good buy, get rid of it.
Yeah, we don't own Constellation. I mean, it's been under a lot of pressure recently. A lot of software stocks have come under pressure. They also had a CEO who unfortunately had to resign last year for health-related issues, and he had been sort of a superstar CEO who had, if you go back and look at a 10-year chart on Constellation Software, the stock's been an incredible performer and compounder of capital, and it's come off a lot. So the valuation has come down, but we're a JC Clark value investors, and this still trades at 22 times EBITDA. Right. So we think it's expensive, and probably would stay on the sidelines until we saw a more reasonable valuation.
All right, we have to wrap it up there, Colin. But thank you very much for joining us today. Appreciate it. And that is it for us here on the street. Thanks to Colin Stewart, CEO and Portfolio Manager at JC Clark, for joining us. Andy Bell up next with the open. The markets are going to open in about 30 minutes. Hold on to your hat for that one, I think.